So listen, I've studied under some of the best future traders in the world or read about some of their interviews. Regardless though, I extracted concepts from them that made them the very traders they are. And in this video, I'll be going over the 21 pieces of advice that some of the top traders in the world give to traders just like you and me. So let's go ahead and dive into it. So to clarify, I got all this information from the book Market Wizards, and the pieces of advice come from 4 traders in that book. 1, Michael Marcus. 2, Bruce Grover. 3, Richard Dennis. And 4, Paul Tudor Jones. And by the end of this video, I'll go over some of the most important advice that traders like us should implement immediately. So let's get started with Michael Marcus. So Marcus' first rule is always bet less than 5% on each idea, not position. So let's discuss the first part of this piece of advice, which is always bet less than 5%. Now, I know you've heard a lot in a lot of trading videos and tips when it comes to just beginners in general, that you want to usually stick to anywhere between 1 and 3%. And that is very, very, very true. Reason why is because you are able to not only capitalize on, making a good amount of money, risking that, depending on your account size, but you also don't have the chance to blow an account. You see, once you start going over that 5% risk on an idea, then it becomes a little bit more risky, because even with 5% risk, it takes 20 wrong ideas to blow an account. Now, it's very rare that 20 wrong ideas happen in a row, but on the odd case that it does, you really don't want to be in that position. So that is the first part of the advice. It's risk less than 5% on every idea, not position. Now let's jump into the second part of the advice, which is when he's saying every idea, not position. Here's the thing. You want to look at every setup that you see or every opportunity in the market you see as one idea. Positions can be 2 or 3 positions in one idea itself. So that's why he gave the overall dynamic of use 5% risk or stay below 5% risk on every idea, because if you do it on every position, you may have 3 positions in on just one idea, which may be 15% of your equity capital on just one trade idea. So this is one of the key things that Marcus kind of talks about, and he's really big on risking a good amount to make money, but also making sure that it's split up into each idea so you protect your capital as well. Marcus' second advice is always use stops. If a position doesn't feel right after you get in, close your position, and always know where you're going to get out before you even get in. It's something called predetermined stops. So it's already knowing where you're going to get out if things go wrong for you during this trade idea before you even get into the trade. This will stop you from pulling your trades longer than you're supposed to, because you already have an area that you came to agreement with yourself before you even got into the trade. So all in all, just to go to say, as beginners, I believe we should develop something called closing conditions in order to know when exactly to close. I think it's been very helpful for me alone, and that is part of an advice that I would give myself. 3, this is a key one here. Follow your own light. Follow your own trade ideas and only trade your own style through the wins and losses. This was something that Marcus went in on. This was one of the pieces of advice that he really believed was the most important, because as traders, just in general, our own ideas is how we're going to survive in the market. We have to develop the sense of independently trading, because without it, if we're dependent on something for trading, we never necessarily learn the skill of it. We never really necessarily develop that intuition. And it's always key to follow your own ideas, even when you may, well, not when you may believe they're wrong, but when others may believe that it's wrong. Because here's the alternative. You take someone else's idea, you lose money, you resent them. You take your own idea, you lose money. You're not going to resent the other person. You may resent yourself, but at the same time, you know that it was all you. You can't blame it on anybody else but yourself. And this is how you improve. This is how you get better trade selections, better trade ideas. I always say, especially, take trading advice with a grain of salt. You can factor them into your decisions, but not to the point where it's going to completely cancel out what you're looking to take or the trade idea that you're looking to capitalize on. So this is a very key point. Follow your own light. And the last bit of information, or the fourth piece of advice for Marcus that he gives here, is the one I just kind of went over. And it's listen to yourself and take others' information with a grain of salt. I think Marcus made a very key point in this whole chapter of the book to make sure that, listen, you got to listen to your own ideas. Other people are going to tell you their ideas, and you take their ideas with a grain of salt. Don't ever, and he made this very, very clear, don't ever listen to someone's idea and then change from your own. No, stick to your own, because you don't get any better like that. You don't get any better jumping from your own idea to someone else's. Stick to your own, but take their advice. Take their idea with a grain of salt. Look into it, but don't ever let it get to the point where it's stopping you from taking a trade, unless you believe that you shouldn't take that trade. And not because of external factors, but because of what you see in the markets. So the next person is Bruce Krover. And one of the key accolades about him is just he is known for being one of the biggest currency he is known for being one of the biggest currencies and futures traders there is of history. And one of the key accolades by him is just in 1987 alone, he was able to amass over $300 million in trading profits. It's $300 million. He's been known to also take $2,000 investment to $1 million in the span of 10 years. So nowadays that may not look like a crazy thing, but this shows crazy consistency to be able to do something like that. And Krover has 5 pieces of advice for us that we're gonna go over right now. So the first piece of advice is undertrade. Stop trading as big as you think you should as a beginner trader. And this advice is directly geared towards beginners. When you're in the beginning phase of trading, you are going to be bad. So stop trading so big. That is one of the key points that he puts on. He say you should be around that 1% risk. And you'll notice that a lot of people are going to say the exact same thing. You should be around a small amount that if you lose, it will not hurt you. And nowadays, if you're a beginner trading and you still want to get that experience of trading, I still suggest load up a live account, but load it up with $250 if you can. Or if you can't, just go ahead and get a prop firm challenge for like $50 and get that live experience, because it's good to get that live experience. But don't ever trade with big money, putting all your life savings in as a beginner trader. I don't even think the pros even do that as well. I don't believe any pros puts all their life savings in and trade, because they just understand the nature of the game. And that's one key thing that he makes sure you really have to understand, is that you have to trade small as a beginner, and you have to build up that experience before you go big. The second piece of advice he gives is don't personalize the market. It's not a living human being, he says. Don't say things that like I wish and hope. It takes you away from the objective state of mind needed. So in the case of personalizing the markets, a lot of people believe that the markets have a mind of its own, when it's not. It's a collective of minds. It's a collective of ideas and sentiments and opinions. And a lot of people tend to personalize the market, believing that it's a person that can do something for you. For example, I hope this trade goes in my favor, is a key saying. It takes you out of the objective state of mind of viewing what's going on in the market, because now you're relying on hope. You're relying on basically another person to help you. And that's one key thing that he kind of talks about here. Never personalize the market, and always stay in an objective state of mind. And how you can do this is very simple. Just make sure you are focused on the process. So the process of getting into your trades, the process of managing your trades while you're in them, the process of reviewing your trades after they're done. Just be focused on the process and the technical things of trading. Third piece of advice, and it's a little advanced here, but let's get into it. Pay attention to taking trades that correlate with each other, because this can pay attention to taking trades that correlate with each other, because this can make your risk far greater than you think. Now, I'm going to give a very clear-cut example so we can understand this piece of content. If you're trading EU and then you go ahead and trade GU at the same time, you may think these are two separate ideas. But the thing is, EU and GU correlate very, very highly. If EU moves one way, GU is going to move one way. If GU moves one way, EU is going to move one way. It's very rare that they'll move differently. And that's one thing, because you may be thinking, okay, cool, I'm risking 3% on EU and 3% on GU. They are two different trade outcomes. I'm risking 3% on each, two different trade ideas, right? Wrong, because they correlate highly, right? So instead of just risking 3% on each idea, what you're doing is you're risking 6% on one idea, because both of those pairs correlate very well. And it goes back to the first pieces of advice that Marcus gave, is never risk 5% over an idea, not position, right? So it is key that you understand that, oh, what pairs correlate? For my futures guys, right? NASDAQ and S&P 500. These pairs correlate very highly. I remember the other day I took a pair on ES that was a loss, and just because NASDAQ gave the same setup, same everything, but it was a little behind, I took that same NASDAQ setup and lost as well too. So my one idea that I had on ES was different from my one idea, or was actually the same from the one idea that I had on NQ. So the key point that he makes here is pay attention to what correlates. Not never trade what correlates, but pay attention to the pairs and the markets that correlate. And remember that, listen, if these two are correlating, then I need to make sure my overall risk for my two separate ideas, which are really one, should be under 5% or should be at a certain point, and you're not risking too much on these ideas. Now, advice number 4, place your stops at areas that will clearly mean that your trade idea is invalid. And this is so key. I remember this is something that I was going through, like evolving not too long ago, about a month ago, and I'm still working on it to this day. But I remember I had a friend who had really, really tight stop losses, and I couldn't understand it, right? Until I understand the idea that where his stop losses are where he wants to be out of the trade, where he doesn't believe anymore that the chances that this trade is going to go in his favor is going to still be there. And essentially, when we place these big stop losses that are like really, really far from invalidation ideas, we're kind of hoping that if it does invalidate the trade idea, we could kind of hope our way that it turns around and kind of hits to take profit. Now, that's one of the key things that you're going to see a lot throughout the video as well too. One of the key ideas is just that make sure when you place your stops, you place it in areas that if it hits, is invalid. Sometimes people do the opposite of what I just mentioned. Sometimes people place their trade or their stop losses prematurely, somewhere really, really close to their, overall position. And once the stop loss hit, it was no real invalidation of the trade. And then the trade just goes back in their favor, right? It's just a little retracement or a little pullback. So these are one of the key things that you got to realize while you're trading. Know where your stops are. For just my example a little bit, I always place stops below structure. Areas where, like, if it breaks this sword and structure, like if it's been making new highs and new lows and it makes a new low, I'm out of the trade, right? Because I put my stop losses below these lows. Now, some people say, oh, your liquidity. Well, right? Because at this point, it's like, if I'm liquidity, then I'm obviously wrong here. And I'm going to take my loss on the chin and move on to the next, right? If it comes down and it stops me out, I'm not looking to get back in. That's it. My idea was wrong, and I'm looking for the next one. So that's one key thing that he kind of talks about here. Just make sure you're placing your stop losses in areas that are, if markets were to get to, it would be invalid. And the last one is number 5. Never put on unplanned trades. If this trade isn't in your trading plan, don't put it on. If the trade isn't a trade idea you were thinking about pre-markets, don't put it on. If the trade idea isn't something that you have tested and you know the data behind, don't put it on. These are things that are just really, really helpful to me. And it's just, don't put on unplanned trade ideas. It's just the cardinal sin of not following your trading plan all over again, just hidden, right? So I feel like this piece of advice is very self-explanatory. If you didn't plan to trade, just don't put it on. And that's it for Bruce Grover, which I believe his advice was really, really good, but not as good as the next piece of advice that's coming from Richard Dennis. Now, if you don't know Richard Dennis, he is a really, really good trader, statistically wise, made well over 8 figures. But one of the key things he's really known for is this group called the Turtle Traders. Now, I get this ad on YouTube all the time where this guy saying, have you heard of the turtle traders? And then he goes about their story and then he just tries to sell me something afterwards. Like, come on, dude. But anyway, I always hear this ad, and it was crazy because it was just basically a group of 14 traders that Richard Dennis coached himself, brought them, you know, he personally picked them out, and then he coached them, and then they amassed a great amount of wealth. And it was really cool because not only has Richard Dennis seen success for himself, but he's also cultivated success in 14 other people to just like us. So this part of the book is where I got the most pieces of advice. Got about 8, so let's dive into them right now. So the first piece of advice, Richard says, is when you have a bad loss, put some time between that and your next trading decision. And it's very simple to understand this. When you have a bad trading loss, one that kind of destabilizes your emotions, you shouldn't take another trade. If you get immediately angry after a loss, you should walk away. I'm pretty sure you hear that advice all the time. The reason why is because when you take a loss and you get hijacked, emotional hijacking, right? Where you are now full with anger or because you feel like you've been betrayed by the markets, or you're full with doubt and sadness. Now you're hesitating on you're taking your next trade idea. You need to take some time away. You need to walk away because now your emotions have reached a point where it's very easy to make decisions off of emotions now. And that's where trading kind of goes downhill. And I mean, I remember going through a 10-month period of just red months because I was disappointed and I felt like no matter what I tried, it never worked. And I kept going during this phase because it's like, you know, why not? You know, I can't stop. But I needed to realize that my expectations were playing a big factor, and it was causing me to be emotionally hijacked every single time I'm getting to the markets. So it's like my mental equity is always at negative. It's always in the red, no matter what time of the period I got. So it took me kind of stepping away for a couple of months to just kind of realize, hey, I need to do this instead, or I need to reset my belief on this. So that's one of the key things. First tip is just walk away when you are destabilized from a trade or when a trade really gets you in the dumps. Just walk away, put some space between that trade and your next trade decision. The next piece of tip he gives is the second piece of advice is write out and brainstorm all of your trading observations. So this is something that I've been doing recently, which has been insanely helpful. What I would do is while I'm in the trade, I would whip out my iPad and I would get on GoodNotes and I would take screenshots of the charts as they currently look and writing down what I'm thinking. So before or after I put on a trade, I will write down what are my trading decisions. What decisions, what factors factored in taking my decision. So I would write those things out because I'm able to also see after the trade what kind of went right and what went wrong. And then the key thing as well too is during key points in the trade, right? Points where price may be getting close to stop loss, points where price may be making an immense move up. I'm watching it and I'm writing down all my thoughts. And Richard makes this point because he's believed that this has been the biggest factor of growth just for his traders alone, is being able to write out and notice trading observations so they can become more familiar with certain things that happens in the market and really build that discretion. So that's the third piece of advice, just kind of recommending just to write out your trade ideas, write out why, the reasons you took your idea, what did you see in the market to take it. Do this while you're doing the decision or after you put on the trade. Don't do it like hours after you put on a trade. Do it immediately after you put on a trade. And you'll see that it'll be very helpful to kind of look back on at the end of the week to kind of see what you were thinking in the current moment. Another very helpful thing is also to record yourself while you're trading and just kind of talk out loud what you're saying if you don't feel like writing. I feel like this one is a little bit more extra because depending on how long you trade, it could be very, very long. But while you're putting on your trade decision, just talk out loud what you see, what you feel. And then this will kind of help you identify like little beliefs that you have that can maybe be kind of bad for your trading, or just in general little observations that you could look more into the charts. This piece of advice is for advanced traders, he specifically says, and it is if your intention and if your intuition and systems are telling you two different things, do nothing until you resolve the conflicts. One of the key things he mentions here is as you gain experience as a trader and as you kind of move along, you build something called intuition. And intuition, discretion, same thing. You're gonna hear them a lot throughout these top traders. They use it as a gut feeling to kind of know what to do in the market, right? Majority of the times as you progress as a trader, you're gonna develop from systems and rules and checklists to straight discretion, which is just making decisions based off of how you feel things are gonna go. And it's crazy, but in the end, it starts becoming profitable because you have all these years of experience. You've seen all these different market patterns. You kind of get a feeling of what kind of happens. An example of discretionary trading is just simply, if you ever learn a strategy from anyone on YouTube and they come up with a rule of advice that you never heard before, that's a rule that they got from their own trading, their own discretion. For example, key ICT concepts, like all of them are just concepts that you'll see if you just view the markets constantly, and you gain that experience. That's essentially what discretion and intuition is. Now, the key main point he's saying here is if those two, if your system, your trading setup, your plays, whatever, and your intuition do not line up, do nothing until the conflict is resolved, because that means you're not too confident in this trade of working out. And one of the key things is you never want to take a trade that you're not confident in, because what's the point? All your ideas you want to be highly confident in. So that is advice number 3, right? If your intuition and your trading system does not line up, do nothing until you can resolve the conflict of what is bothering you. So I'm going to kind of speed run here. 4, keep in mind that anything can happen in the markets. You've heard this from Mark Douglas and a whole bunch of other traders. You need to keep in mind that anything can happen. Don't believe that you know what the market's going to do next. Believe that you have an idea of what the market may do next, but anything can happen. It's very self-explanatory. The reason why you want to do this is so you don't close yourself off of opportunities that are potentially presenting themselves to you, but you can't see because you believe the market's going to do this and that. 5, always make your own decisions. I'm not going to explain this too much because you've heard this from the first part of the video by Michael Marcus, and it's very simple. Richard Dennis says the exact same thing. Always make your own decisions. Don't have anyone make your trading decisions for you. 6, learn from your mistakes. It's very simple. Learn from your mistakes so you don't make them again. And here's one of the biggest quotes that you're going to ever hear. And here's one of the biggest quotes that I ever really paid attention to, is that failure is the best teacher. And it really, really is. Because in failure, failure is never failure, it's always feedback. Just like success is never success, it's always feedback. Our perception of these things makes it failure, which is bad, and success is good. But all it really is in the common world of just regularity, regularness, if that's the word, probably not, but it's just feedback, right? So just look at it as feedback. Feedback of what went wrong shows you what not to do, right? And it allows you to eliminate this off your options of what to do next, right? And the exact same with success. With success, it shows you what you should be doing, and it shows you what else to eliminate because what really didn't help, right? So that's 6, learn from your mistakes. 7, don't get caught up in the daily fluctuations in your equity. What this just simply means is don't get caught up in the daily trades that, win here, lose here, win here, lose here. Just keep your view long term. Don't think in a trade by trade manner, think in a series of trades. Just like I always made this illustration back in the past, when you are viewing these sports teams, right? You have college playoffs, you have NFL playoffs, and then you have NBA playoffs. What's the difference between all of these 3? Well, college playoffs and NFL playoffs are the same. It's one and done, right? So if you lose this game, you're gone. It's over, right? So imagine the amount of stress it goes into every playoff game when you know, oh snap, if I lose this game, it's over. Versus in the NBA playoffs, right? It's four and done, right? So as whoever wins four first goes on to the next round. And it kind of gives you a little bit of peace because you know you can lose a game and still win the series. So that's why it's looking at it by a series of trades rather than a trade-by-trade basis. And then last but not least, which I believe is the most important one that he gives out of all of these, is focus on your actions, not your outcomes. You've probably, if you're new to this channel, you probably haven't really heard this. If you're new to the channel, you haven't heard me say it, but if you've been here for a little while, you understand that I'm very, very key on processes over outcomes, and it's just self-explanatory. Processes, let's scrap that actually. And the last one, which I'm not going to speed run, I'm actually take my time to explain, is don't focus on your actions, or actually, sorry, focus on your actions, not your outcomes. And it's, in this case, all you can control is your actions, especially in trading. That's all you can control. You can't control your outcomes at all. In trading, the only thing you have control over is your actions. You will never have control over your outcomes. And it's the exact same in life in general too. So all you can do is focus on the process. Focus on the day-to-day actions. If you focus on the outcomes, nothing is going to benefit you except you're going to get a new problem called worrying. All you can worry about is literally just doing what you need to do day in, day out. And for traders, this looks like following the right actions, following our trading plan, not over leveraging. And it's very, very simple that you'll notice that when you realize that actions are the only thing you can control, then it makes it that much easier to succeed. So, last piece of advice that Richard Dennis gives is focus on your actions rather than focusing on your outcome. And the last person on the list is Paul Tudor Jones. Really quick side note, if you're watching this video, you've seen the literal background go from black to like sunlight, which is crazy. I'm up very early recording this video. Anyway, regardless, get back to the video. So Paul Tudor Jones, some of his accomplishments is that he's just a really amazing trader. You'll start to notice that these top traders are really just amassed a lot of capitals and profits in trading. But one of the special thing with Paul Tudor Jones is that he launched his own money management firm, and he started in September of 1984 with just a little over 1.5 million in capital for the overall firm and he started with little over 1.5 million in managing capital. And 4 years later, in October of 1988, that 1.5 million turned into $333 million in the span of 4 years. He's been known to have an amazing track record just in general as a trader and also as a firm. And he gives 4 pieces of advice. Now, I'm going to speed run through 3 of them, but the 4th one is the one that I want to pay the most attention to. So let's hop into it. So the first one's very simple. Reduce your risk when you're trading poorly. And it's kind of just a no-brainer, right? If you're trading poorly, you don't want to increase your risk, right? You want to reduce it. How do you know when you're trading poorly? I kind of view it as performance. So when you notice that your performance is off, not necessarily P&L, but just how you're performing as a trader, like you're taking unnecessary losses, you're taking a lot of unplanned trades, like you're just not being able to stick to your strategy. And then also you're just not performing on the P&L aspect. Your P&L equity curve is starting to trend down, right? That is a clear indicator that you're trading bad and you're trading kind of poorly. And you need to just take a break for a second and kind of recoup and reduce your risk. Now, the second piece of advice is never trade under situations you don't have any control over. So no brainer. You shouldn't trade over news, especially a lot of people, they can use technical analysis and fundamental analysis to kind of predict where news is gonna, what direction news is gonna go in. But the thing is about news, it's so unpredictable. It can spike down, stop you out, and then go up, right? So just never trade in situations that you can't vividly control. But if you look at this overall concept, this is why I don't really like it too much. No, let's not say it. But if you look at the overall concept, right, you can't control any trading condition. So I would reframe this to never trade under conditions that. The second piece of advice is just never trade under situations you don't have any control. Pretty self-explanatory. Don't trade news. Don't trade high volatile news if you know it. The third is define stops before entry. You've heard me say this earlier in this video, and I told you there's a lot of things in common that these traders have, but always define your stops before getting an entry. Now let's dive into the point that I really want to talk about. All right, so the fourth tip, and the tip that I really want to go over the most, he says, focus on playing great defense, not offense. And it's very, so the fourth piece of advice that he gives, and the fourth and final piece of advice that he gives, is focus on playing great defense, not offense. As a beginner trader, you should be focusing on defense, and your defense in trading is risk management. Essentially, risk management is the defense that's stopping the markets from scoring on you, quite literally, and taking all your money, right? So it's very key that you have really good risk management in trading. And I think if it's one thing we're going to get away from this video today, it's just simply make sure you understand the importance of risk management, understanding that stop losses is a part of risk management as well too. So all of these things, as well as ideas, are different from opportunities or positions, I should say, and also that two correlated ideas are really just one, and the amount you risk on each idea can be far greater if you don't pay attention to it, right? So one of the great things here in this book that he just kind of talks about, or in this Paul Tudor Jones section, is just mainly focus on playing great defense. Focus majority of times, and I believe as a beginner trader, on playing great risk management on all your setups. And that's it. That is the 21 pieces of advice that I got from some of the top future traders in the world. Now I'm going to go over the 4 that I believe are the most important and we should implement. It's very simple. It's the first one that we got from Michael Marcus, which is follow your own light, follow your own trade idea, and only trade your own style through the wins and losses. At the end of the day, all of our goals is to become an independent trader. We don't want to rely on signals, or I would hope at least we don't want to rely on signals, and we don't want to rely on other people to make trading decisions for us. Because if we lose access to them, then we lose access to our trading skill. And I don't think anybody wants that. So it's very important, and I feel like this is probably one of the most important points over these 21 concepts, is just to focus on really trading your own ideas. The second one is never take unplanned trades. I feel like this is very important, especially for the level I am at as a trader. You may be at the level where you already have a trading plan, right? You need to stick to it. There should be no reasons why you're taking trades that are unplanned for. You're taking trades just because you feel like taking them. Now, these can work out in the short term, but in the long term, if you don't have any data, if you don't know how it's expected to go, then it can be really harmful to your trading. The third piece of advice that I believe we should implement is just writing out all of your ideas and brainstorming all of your trading observations. It's very key to write out your thoughts, write out what you're seeing in the markets, write out your decision factors that are going into every decision you're taking in the markets, because it gives you a chance to look back on them when everything is said and done. And one of the key things that I've learned this year so far is something called resulting. And resulting is the form of taking a outcome and tying it to your decision. So bad outcome, bad decision. And necessarily that isn't true, because you can make a good decision and still get a bad outcome. You can make a decision to drive safely with a seatbelt and follow all the rules, and somebody can crash into you still. That is just life, right? So it is key that we learn from our decision quality and not just tie them to the outcomes, and make sure that we're really doing the proper things and focusing on all of the aspects that are going into our decisions, focusing on all of the trading observations that we're making in the market and having a spot to jot them down. And then last but not least, the biggest piece of advice that I believe all of us as traders should follow. And if you're new to this channel, you probably don't know. If you've seen my channel a couple times, you see some of my trading videos already, you probably already knew which this point was going to be. It's just focus on your actions, not your outcomes. It's very simple. Focus on the process, not the outcomes. Focus on chopping wood and carrying water. Learn to chop wood and carry water, which just simply means learn to chop wood, carry water, right? Saying just simply means listen, focus on the commit. Learn to chop wood, carry water, right? Focus on the process, commit to the controllables, and surrender to the outcomes. And that right there is going to put an end to this video. I hope you guys truly enjoyed. If you have any piece of feedbacks or any piece of comments or whatever opinions, whatever it is, leave them in the description below. And if you made it all the way to the end of the video, shout out to you. You're a real one. Peace and love. And until next video, which probably will be next Sunday, peace.